Imagine a warehouse where robots don't just move boxes, but think, adapt, and organize the entire flow of goods with superhuman efficiency. This isn't science fiction. It's the reality being built by Symbotic, a pioneer in AI-driven robotics that's reshaping the supply chain for some of the world's largest retailers. If you haven't heard of them, Wall Street certainly has. The company's stock has exploded, rocketing up over 225% so far this year. This meteoric rise isn't just hype. It's a bet on a future where automation is not just an option, but a necessity. The bull case for Symbotic is built on a mountain of evidence. First, consider their order book, a staggering $22.5 billion backlog. That's not just a pipeline, it's a multi-year guarantee of revenue, providing a level of stability few growth companies can claim. They are executing on this demand, firing up 10 new installations and bringing 6 more online in just the last quarter. But it's not just about getting bigger, it's about getting smarter. Symbotic has boosted its profit margins on core systems by more than 4 percentage points, a direct result of smarter cost controls and a radical new storage design that slashes setup timelines by months. This innovation is also unlocking entirely new industries. They just landed a major partnership in healthcare with a medical distributor, opening a door to hundreds of potential new sites. With over $1 billion in cash on hand and analysts forecasting earnings per share to leap by over 60% next year, the picture is one of ferocious momentum, backed by a 5-year stock return of over 750%.
But for every soaring stock chart, there's a story of risk. Symbotic is still chasing consistent profitability. The company just posted another quarterly loss of $19 million, falling short of analyst hopes for a profit. A look under the hood reveals rising costs in its support services division. Then there's the concentration risk. A huge portion of Symbotic's business is tied to a single massive retail client. If that client strategy were to shift, it could create serious instability. The competitive landscape is also fierce, with established giants and nimble startups all vying for a piece of the automation pie. And we have to talk about valuation. With a price-to-book ratio soaring over 200, the stock is priced for perfection. Any stumble in its expansion could send it tumbling. This concern is echoed by some analysts, who've revised future earnings estimates down by about 30% over the past year, and by a major bank that recently issued a sell rating, citing a lack of diversification. So how did they actually perform last quarter? The results paint a complex picture.
Revenue was a standout success, hitting $618 million, growing 10% and crushing estimates. The company also guided for an even stronger next quarter, projecting revenue to jump between 25% and 29%. But this strong growth was tempered by that earnings miss. The company is pouring money into its future, investing heavily in next-generation technology like extended-life batteries for its bots through a partnership with Nibald, and expanding its cloud AI platform to optimize logistics from end to end. They're also expanding their talent pool globally and using joint ventures to push into new regions. It's a classic growth story, spending big today for a dominant position tomorrow. Ultimately, what we're looking at with Symbotic is a fascinating battle between disruptive innovation and the hard realities of financial performance. The company's technology is undeniably at the forefront, offering a powerful solution to the chronic labor shortages and efficiency demands plaguing modern supply chains. Their market momentum and massive backlog position them for potential leadership. Yet, the persistent losses, intense competition, and sky-high valuation demand caution. Symbotic represents a high-stakes bet on the future of automation. The question for any investor is whether the groundbreaking technology will pave a clear path to profitability before the market's patience runs out.